Welcome to day 4 of PCP 2.0. We are going to be discussing order types. While yes, we are currently doing this while the market is having one of its greatest days all year. This goes to show I really want to get this done and want you guys to understand how to trade efficiently because I'm doing this instead of trading the crazy market we're having. But we're going to rip through this, talk about order types, not waste any time with order types do I use and things like that. So without further ado, all order types, okay? All order types worth mentioning, rather. Well, yes, don't get mad at me. There's probably more order types out there. In fact, I know there are, but in my opinion, they're just not worth talking about because I really haven't used them. And quite honestly, I only use half of these now. So we have market, known as MKT, limit, LMT, OCO, or order cancels order, stop loss, and stop limit. Now, I haven't looked at stop loss in a while. Is there an abbreviation for loss now for your broker, or is it just STP loss? Just out of curiosity. Anywho, so first of all, market orders do not work during pre-market or post-market. They only work while market is open. Hence the word market order. Now, what a market order is going to do is it's going to fill you immediately on command. Not immediately. And we'll get into that. It's going to fill you guaranteed at whatever price the current market price is at. If you're trying to use market orders during pre-market or post-market, they are not going to work. Understand you have to use limit orders during those times, and those times are from 4 a.m. to 9:29 a.m. EST, and then from 4 p.m. to 8 p.m. EST, market orders don't work. But from market open to market close, they do work. Now, we're going to get into in a minute why I don't use them anymore. Limit orders are great. Basically, it means you put an order in, a buy limit order. Say you put it in at $1 and the stock is at 110. Well, if that price gets down to $1, it's going to fill that order right at $1. Now, say the stock price is at 110 in this scenario, and you put a limit order in at 125. Well, what you're saying is, I want to get filled at this price or anything cheaper than this price. That's what you're saying with a limit order. So, indeed, what's going to happen is you're going to get filled at 110. You do not want your limit orders to exceed the current price of the stock, or else you're going to get filled immediately. So, you need to have your limit orders below the current price of the stock if you're looking to use a limit order. Now, I use a stop limit, and we're going to talk about that in a minute. Order cancels order, very simple. There's two orders. There's okay, if the stock hits this price, I'm buying. If the stock hits this price, I'm selling. You can have multiple orders in, and then once one of them gets filled, it cancels the other order. Hence, order cancels order. So you can have a buy. Say if it hits 110, I'm going to buy. If it hits 190, I'm going to short. Whatever happens first, it cancels the other order, and you're golden. I don't use those really. Stop loss. You guys have heard where do you put your stop loss and all that stuff. Well, yes, you should know where stop loss is. I use a mental stop loss, meaning I wait for a stock to hit the given price point of which I would have a stop loss, and then I sell with other orders. Sometimes putting an actual stop loss in can be tricky because you can get a wick can fill that order, and I don't need to go into super detail into that. And a stop limit is, okay, I want to get filled at this price or anything higher than this price, but do not fill me until it gets at this price. That's what I use often. So if the stock is at 110 and I put my stop limit in at 120, unlike the limit order, which would fill me automatically, it's waiting for that stock price to approach that key breakout level, and then I'm in, and then it continues higher. Okay, so those are all the orders we talk about, and you know about them more in this lesson. Now, moving on, basic concept. Okay, there is a ask and a bid price to every stock. Okay, and the difference in between those prices is called slippage. On the left is the bid price, which is buyers. Bid equals buyers. Asker or sellers. I don't know. So on all the orders on the bid right here are all the people that want to buy this stock at this given price point. This is not a level 2 lesson. We are just looking at the first block. Okay, so right here is the current highest buyer, okay, at 120. And right here is the current highest seller at 129. So if you put your order on the bid or ask, you are saying, so for example, if you want to guarantee yourself to be filled, you are going to want to buy what the lowest seller is willing to sell it to you, right? Basically, what's happening here is the stock market is the world's biggest auction site. Okay, so if you're like, man, I want to buy the stock, but what's the cheapest price? The cheapest price to guarantee yourself to buy right now is 129. And if you're like, man, I want to sell this thing, I'll take whatever anyone's willing to pay for it. But who's the highest bidder? Well, 120. Okay, so if you want to sell it, that's where you're going to fill that. Now, the difference between these two prices, because they're not always very close together. In fact, some stocks can have a whole dollar share difference in slippage or more, while some of the stocks we trade have a 1 to 2 penny a share difference in slippage. Now, that slippage can kill traders, and it does all the time. Because if you got filled, think about how profitable you would be. And this is why I don't like some paper trading platforms, is because they always seem to fill you right at the bid and sell you right at the ask, which is very, very unlikely that's ever going to happen. But that difference in slippage is what you're going to be paying on both sides. So, for example, if you're trading a stock that has a high slippage, I don't like trading stocks with high slippage. You are going to buy at 129. Okay, but if you want to turn around and sell it immediately, you're going to lose 9 pennies a share right off the bat, guaranteed, just like that. So what happens is you have to wait for this left price, the highest buyer, to get up to 129 to even be at break even. Okay, so what's up happening here is if you end up buying at 129, okay, but then the stock price goes down to $10, it only dropped 20 cents a share in value, but you lost 30 given the difference, the slippage. And you have to understand you're going to get double dinked on slippage when you buy and when you sell. Okay, slippage is not good. You want to see stocks that have closer slippage, obviously, all the time. That doesn't happen all the time, like we saw today on VTGN. The high volatile ones, the very volatile ones with a small float, often have a low slippage. And the reason for that is there's less market makers. It is less competitive because there is less supply and the demand isn't quite there. So when there's not much demand, you can see a spotty price action. Now, for example, say you are trading an Apple or a SPY, they don't have a crazy slippage because there are so many market makers providing liquidity for those stocks that there's often going to be little to no slippage. Okay, moving on. Oh snap! We got Advanced Concept J Money in the chat. So we're talking about makers and takers. And for some reason, when I said maker, I thought of a baker. So we got bakers versus the Undertaker. So bakers and takers, or makers and takers. But this is what I think is quite funny about. So we have makers, which is just a baker. I don't know why I put that there. And then we have takers, Undertaker. Okay. So advanced concept, there's makers and takers of liquidity. Okay. And what happens here is some orders are going to make you become a maker, and some order types are going to make you become a taker. So, for example, if I put a limit order on my level 2 and say, okay, I want to be filled at this price or anything below it, I now just became a market maker because I'm providing liquidity for the market. If I go back to this example and say, these are all limit orders, by the way. If no one wants to put a limit order in and everyone wants to trade market, there now becomes zero liquidity. And if you know anything about liquidity, you need liquidity in order to trade. Okay, you need stocks to be liquid. You need to be able to move it in and out. And if there is not enough liquidity, what ends up happening is stocks become untradeable. So how the market makes it so you are incentivized to become a maker, because oftentimes being a taker is easier of liquidity, and we'll talk about that, is they give you rebates. So if you're paying in commissions, well, if you put a limit order down on the bid or the ask, you pay far less commissions, and you actually can get rebated those commissions by becoming a maker. Now, in my opinion, those rebates are not worth becoming a maker of liquidity, because oftentimes I think it's just best to be a taker and be selfish in the market. It's just how the market is. You got to be selfish if you want to win. And I am indeed a taker. And what that means is whatever price is on the level 2, I'm taking those shares off the table. I'm taking liquidity away. So I'm going to be paying a lot more commissions. However, I am not going to have to worry about my order not being filled. Because if, for example, the stock price never gets up to 142, this kind gentleman's order will never be filled. And that's going to suck. and he's going to lose a lot of money. So for me, I would like to become a maker instead of, or I like to be the undertaker instead of this baker. Okay. And then going back to this, a market order is it's going to fill you at this level. So say if you want to buy, you're going to take the lowest buy order, or the cheapest seller. If you want to sell, you're going to take the cheapest buyer. Okay. The reason why I don't like market orders is A, they don't work 24/7, which can be frustrating. A lot of people are like, I'm trying to buy, it's not filling my order. The fact of the matter really is, it's not filling you, just trying to use a market order. But another thing is, the market likes using inexperienced traders who use market orders. Because what happens is people who put direct limit orders in are going to be the ones that are going to be getting filled. People who put market orders in, the market's going to put them over to the side for a second and see where the stock price is going to level out, and then fills them. And while it might just be a few milliseconds, that can be the difference in a crazy amount of what we're trading and what we saw today. That can be the difference between being filled at 30 and being filled at 60. It's just a fact of the matter. So I don't like market orders generally for that reason. If I have to bail out, I do have a bailout button that is a market order. However, I am a limit guy. So how can I be a taker of liquidity, but also use limit orders to make sure I'm getting a priority fill? Well, what we have here is the advanced concept. Bada bing, bada boom. So what I use is I use a limit price, a stop limit price, or a limit price. Given we'll talk about the difference in a minute. But I say, okay, I wanna buy on the ask. If you remember what the ask is, guys, that is the cheapest seller. Okay, but plus 5 cents a share in slippage, which means in this example, if the cheapest seller is 129, and I put an order in to buy at 129 plus 5 cents a share, yes, my order is going to be going in at 1034. But every broker has a software that tells you just because they put in an order at 134 does not mean it's going to fill me at 134. But basically, what the order is saying is fill me at 134, or if you have anything cheaper, I'll take it. So if hypothetically that order goes in at 134, but there's still that seller at 129, it's going to fill me at 129. And what happens here is it takes out that millisecond of when the market makers pull those market orders to the side and wait for the stock to balance out and then fills them. This is going to prioritize my fill, and this is going to fill me almost 9 times out of 10. I'm actively thinking about if do I want to switch this to 10 cents a share slippage. And the reason is when you trade stocks that are $15, $20 a share, or like today, that 5 cents a share slippage is going to not do a whole lot. 10 cents a share is going to do the same thing. It's going to put the order in. Say I want to get filled at this price or anything cheaper. I still would have got filled at 129. I have to think about it a little bit more and ask some other traders. Now, here's the thing. If I am very confident in my fill, so for example, by using these orders, I'm not going to get the world's best fills. I'm going to get guaranteed fills, and I'm going to be getting filled fast, but it does not mean I'm going to get the world's best fills. And the reason is I am taking, you cannot simply be a taker of liquidity and expect to have the world's best fills. There's a pro and con, a yin and yang aspect to it. So if I want to be a taker, I have to sacrifice having better fills. If I want to be a maker, I'm going to sacrifice getting my order submitted, and sometimes the stock not filling my order, but I know I'm going to get filled at a good price. So what do I do here? Well, I have my Stream Deck. Stream Deck sales are going to go up 1,000% after this. I'm just kidding. That has preset orders. I want to show you guys every aspect of my trading ability, so I wanted to make sure I didn't leave this on a lesson. You can use your keyboard, yes. However, my pinky was holding on control on one day as opposed to shift, and that simple aspect of my pinky doing that cost me $12,000. So I said, you know what? I'm done with that. I want to click just one button and not have to deal with my keyboard. Also, my son's was smashing my keyboard and had some orders go through. But what I do is now I have all my main buy and sell orders on one page. Okay, so these are all my main buy and sell orders, and then on the next page, you can see there's a whole other row of buying and sell orders. And what those orders are is the exact opposite. So what happens here is now these new orders, instead of buying ask plus 5 cents a share, I am now putting orders to sell on the ask. And this is not meant to confuse you. This is an advanced concept. So if you rewind and watch this later, you can. However, what I'm doing here is, in this example, if a stock is skyrocketing and I'm fairly confident it's going to hit my sell order, instead of selling on the bid, and in this example, filling me at 1020, If I'm very confident in the stock filling my order, what I'm going to do is I'm going to say, okay, sell me on the ask. So what happens here is I am now going to become one of the cheapest sellers out there. And if the buyers can increase their price and match my price, it's going to fill me much better. So what I'm saying here is I want to get filled at 129 as opposed to 120, make 10 cents extra a share. Do I always get filled when I use the second page of orders? No, I don't. That's why I barely use them. I only use them if I am very confident in the stock squeezing in price. Hence, there's a big buyer coming in. It hit a key breakout level, and I want to start averaging out. I will put those orders in to see if I can get filled at a better price. Now, I also have some backup orders, like an O SHIT. I didn't fill my order. Now it's reversing. I can click flatten, which will just fill me at the current price. I can cancel my orders with a click of a button, and then I could then simply just replace that order with selling on the bid to guarantee my fill. So I do have two different pages. If I'm feeling confident and I want to squeeze out an extra 10 to 15 pennies a share, I have done that in the past. When I'm really confident on the setup, I do that. However, 9 times out of 10, my orders look like this: buy ask plus 5 cents a share. So that's how I get filled. Get filled quickly at decent price points. I guarantee myself getting filled. And these orders that I am showing you right now work in all pre-market, market open, and post-market. So I love it, and that's why I like using them. And the last thing, smart routing just means it's going to fill you at the best possible price point. And then special instructions hidden. I don't want other traders to see my order, because there can be times where I size up and I could potentially affect the price of a stock if other traders can see my big buy or sell order. Obviously, I hate hidden buyers and sellers. I get that, but hate the player, don't hate the game. So I'm a hidden buyer oftentimes. Okay, so that is it for today, guys.